Hi, dreamers. I wanted to talk about something quickly this week, and it's about REITs. 2024 is supposed to be the year of REITs, with incredible rebounds in front of us because of the lower interest environment, which I've talked about in a couple of recent videos. But there's one category of REITs that I am steering clear of, and that's what I'm going to cover today. So let me start with this article from Fast Company, which is all about flexible offices. And in this article, it talks about the fact that in 2024, we're going to see plenty of return to office mandates, but that those mandates might look a little bit different than they have over the last 2 years. And one of the things they talk about is that in recent surveys, only 19% of companies define return to work as 5 days a week in person. In fact, return to the office could mean 3 days a week or 1 week a month. And actually, in a separate Resume Builder survey conducted a few months ago in March, found that 37% of employees who were forced to return to the office were unhappy with their employers. And in fact, 29% say they intended to resign unless the policy is reversed or revised. Ouch. And there's even other surveys, like from FlexJobs, that say that 57% of current remote employees would look for a new job if they can't continue working remote. And so it goes on to say that there's an emphasis now on hybrid work. And if you're working at a 9 to 5 today, which, as you know, I am not, you're probably feeling this real time at your own office. And so what does this mean? Well, this recent Seeking Alpha article caught my attention. And the title is Sell Alert, the slaughter of office REITs is just beginning. And in this article, it starts to highlight just a few big companies that have openly talked about reducing their office space. For example, Charles Schwab going towards a hybrid work model where they are downsizing offices across their network, Boston, Chicago, Nevada, Jersey City, and even closing offices like in Atlanta, San Antonio, San Diego, St. Louis, and Tampa. And in September, J&J talked about slashing its Tampa office by more than 60%, leaving 90,000 square feet behind. And even in October, companies like Dropbox would even pay $79 million to go ahead and give up 165,000 square feet in San Francisco. And even Microsoft is going to be vacating 50,000 square feet of office space in San Francisco. And here's the kicker. In other surveys conducted mid-2023, half of the world's biggest companies are planning to cut office space by 2026, with a 10 to 20% reduction being the most common. Wow, that is scary. And so with office leases being pretty long typically, that means that as these leases come up, companies will be taking a close look at exactly where and how much square footage they need. And actually, here's an interesting graph which shows the top 10 MSAs with the highest lease rollover in 2024, this year. And you can see some scary numbers here, with, for example, New York at 10 million and Chicago at 3 million. But take a look at that MSA office distressed rate. So even though that 10 million looks high in New York, it's only 2.8% of the market, whereas Chicago's 3 million square feet expiring is almost 20% of the market. And worse, if you take a look at cities like Atlanta at 20% and Charlotte at 36%, these are very high percentages of lease rollovers in 2024. And in this article, it goes on to talk about very specific office REITs that could have significant issues, including Boston Properties, or BXP, Kilroy Realty, or KRC, City Office REIT, or CIO, which cut its dividend in 2023, and SLG, a Manhattan-based office REIT, which not only cut its dividend in 2023, but already has done it again. And I just wanted to show you one more article, and this is S&P Global Market Intelligence. And one graph that caught my attention in this article was down here at the very middle. Take a look at this graph. Essentially, it shows 2019 through 2023 and the median office rent per square foot as opposed to the median office occupancy rate. And we all know that the pandemic happened in 2020. So before 2020, the occupancy rate was high, between 94 and 92%. So mostly occupied. And then through the pandemic of 2020, 2021, obviously, the occupancy rate went down over time. But even as we've recovered through 2022 and now into 2023, you can see this trend line continuing to decline as these office leases come up. And so how are they dealing with that in order to continue to pay out? Well, as you can see, they are raising the rent. And so, my dreamers, there's so many times that I create videos about things that I want to buy and rotating into industries and sectors that make a lot of sense for the rebound. But I just wanted to take this time to point out one particular sector that I see having extreme difficulty, and it might not pop in 2024. It might take a couple of years for this industry to really collapse. You know, a lot of times I talk about being a macro investor and looking at some of the bigger statistics from an economic perspective in order to draw my conclusions. And this is one of those examples where I can clearly see a long-term environmental change that isn't likely to reverse anytime soon. Because based on how society has changed, I think we're looking at a long-term, whole different way of working, and we might just have too much office space, especially in certain cities. So I hope that's helpful for you as you take a fresh look at your REITs and also take a look at what percentage the office REITs are in your portfolio. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.